Welcome to the Accountancy Learning AAT sample paper walkthroughs. In this video, I'll take you through the Level 3 Financial Accounting, Sample Paper 1, Task 5. So Part A asks us to identify the principle being described in each of the following scenarios. Value of goods sold but not yet paid for at year end is included in the sales for the year. So this is about matching. We're matching our sales to the time period in which they happened. So this is known as our accruals principle. Rena owns a greetings cards business. When she takes a card for her own use, she records this as drawings. So this is keeping business separate from personal, known as the business entity. Stationery items such as staplers are treated as expenses rather than non-current assets. So this is whether something is going to make a significant difference to the business. So it's known as our materiality principle. Employee morale is not recorded in the financial statements. So that's because it's only money measurement in the financial statement. Now we need to identify the enhancing qualitative characteristics being described in the table below. Knowledgeable and independent observers can reach a consensus that the information is faithfully represented. So be careful not to jump and just use this to select your answer. But what we're saying is, can knowledgeable and independent observers actually agree that they are faithfully represented? So it's about verifying it, so verifiability. Information is clearly and concisely classified, characterised and presented. So this is about whether it can be understood. So understandability. Now we need to identify whether statements are true or false. So the interpretation of a business's financial statements using ratios is only useful for potential investors. So this is false. Internal and external users of financial statements will be able to use the ratios to understand how the business is performing. The usefulness of ratios is enhanced when they are compared to different businesses, time periods, or industry standards. So this is true. A standalone ratio on its own may not give us too much information, but when we compare that against different businesses, time periods, or industry standards, it means we can then assess how well that business is performing. A disadvantage of ratios is that they are based on past performance, which may not be valid for making predictions about the future. So this is true. They do provide us useful information, but it cannot help make predictions about the future because we can only say something is likely. There is a probability, but we cannot be predicting the future to any great certainty. All other things being equal, if gross profit percentage increases, then net profit percentage will decrease. So this is false. If everything is equal, if the gross profit goes up, the net profit will go up as well. So next we've got extracts from the accounts of a client for the year ending the 31st of March X3. And we need to now calculate some ratios. So the return on capital employed. So what is the return on the investment in the business? We need to answer to 2 decimal places. So what's our return first of all? So our return is going to be the profit for the year of 59,160. We're going to divide that by what's been invested. So that's our current liabilities and our capital. So the total of 97,500 and 136,400. Then multiply that by 100 to get our percentage. And that to 2 decimal places is 25.29. Now we need to calculate the net profit margin. So how much profit are we actually making on our sales? So again, we will take the profit figure, but now we're going to divide it by our sales. Then multiply it by 100. And take it to 2 decimal places to get 13.96. Then we're told that shop wages as a percentage of revenue has risen this year, and we now need to identify whether the following scenarios could have caused the change. So employees were awarded a pay rise during the year without any corresponding increase in revenue. So if the wages have gone up, it means there's more expense to the business, but there hasn't been an increase in revenue, which means that percentage of revenue, the shop wages as a percentage of revenue, will have increased. So yes, that could have caused the change. Revenue has risen during the year due to increased advertising, but no extra staff were employed in the shop. So this wouldn't have caused the change because the revenue has risen, but the wages haven't. So actually, that means that the percentage would have actually reduced. Then finally, part E, some true or false statements. If a business has a markup of 25%, the profit for the year figure will always be positive. So this is false. It doesn't really matter what the markup is, because if the overall expenses are more than the overall revenue, then it means they will have a loss. The statement of financial position is completely independent of the statement of profit or loss. So this is false because we need to put our profit or loss in our financial position. And that concludes task 5.